Are you a broke loser? Do you want to stop being a broke loser? Well, buy my book on Amazon. It's $2.99 for an ebook or $9.99 for a hardback. It's called Stop Being a Broke Loser. If you buy this book, you will no longer be a broke loser. So buy it now. Welcome back, Strongman Personal Finance. I am Christopher Bell, certified public accountant, long-term Boglehead investor, author of the book Stop Being a Broke Loser. It's on Amazon for $3 for the ebook. The hard copy's $9.99, okay? And not a big fan of Johnson & Johnson stock. Now, all my fans, they come on here and they see me talk about all these freaking stocks. And almost every time I'm like, it kind of seems overvalued. And that's true, because right now this market is freaking stupid, at least in the United States. Historically, the S&P 500's price to earnings ratio has been roughly 15. What is it right now? I think it's in like the high 20s or 30s. And the forward PE is like 21, as much as you can trust that, okay? That's still pretty freaking overvalued. So all the stocks, or a lot of the stocks in the United States, especially large caps, are freaking overvalued. That's just how I feel, okay? You can disagree. You can call a lawyer. I don't care. Johnson & Johnson is no exception, okay? Is it a very profitable and productive company? Yeah, sure. Is it a buy right now based on my personal metrics? No. But if you have a different return that you want, maybe it is a buy. So let's go look at it. So, average 5-year PE, 34. Okay, that's pretty freaking high for basically a company that's barely growing like Johnson & Johnson. High profit margin, almost 20%, and high gross margin. 5-year return on invested capital, 14%. That's pretty good. It's got a dividend. The dividend seems secure because the price to free cash, or the 5-year average free cash flow is 80% higher than dividends paid. That's great. And then you can read a little bit about the company. Pharmaceuticals, medical devices and diagnostics, and consumer stuff, all right? I don't think I buy many Johnson & Johnson products, you know? I like great value, cheap stuff. But just looking at some of the returns, I mean, they're not bad. But let's go look at the income statement. Now, looking at revenue, it's kind of freaking all over the place. And that's because of acquisitions. This company just buys other companies like freaking crazy. How do you know that? You have to go look at the statement of cash flows, which we will do. So here's the revenue growth, $64 billion in 2012 and $89 billion in 2021. A lot of that came from acquisitions. As you can see, 2012 to 2013 went up by about $5 billion, then by about $4 billion, then revenue dropped by about $2 billion, then dropped by $1 billion, and then went up by about $2 billion. And then you see a massive spike in revenue from 2017 to 2018. Whenever you see that, don't just think the company just got amazingly better. Go look on the statement of cash flows, which we'll go to right now, and then we'll go back to the income statement. And go look at cash flow from investing and then look at acquisitions and dispositions. If you see negative numbers here, that means they're buying other businesses. The negative number represents cash flowing out of the business. A positive number means that's cash flowing into the business, which means they sold a division. So looking at this, Johnson & Johnson is just buying like freaking crazy. And as you can see in 2017, they spent $9.36 billion on acquisitions. And then they spent $30 billion in 2018. That's why the freaking revenue went up from $72 billion to $80 billion, okay? That's why. Gross profit, whatever, seems to be, I don't know. It's a little bit hard to really see percent or like analyze this super quickly, which is why I always say you have to supplement with Morningstar, because they don't have vertical and horizontal analysis here on Everything Money, but they should. I'll write them. Maybe they can give me a free subscription for a year if I can give them some recommendations, okay? So obviously it's a profitable company. That's great. Balance sheet, I don't really give a crap about the balance sheet. I mean, you can check current ratio, current assets divided by current liabilities. Yes, I don't think Johnson & Johnson's going out of business. You can look at trends in long-term debt, other long-term liabilities. Not really going up like crazy. It seems to be pretty flat, to be honest. I mean, there's a couple ratios you can look at. You know, look at debt to equity, stuff like that on the balance sheet. But I care more about cash flows. That's what really matters. And debt is going to be reflected in the income statement and the statement of cash flows because of interest and principal repayments. So statement of cash flows, obviously you want to look at cash from operations. This is the company's positive or negative cash flows from what they actually do. So when you look at the statement of cash flows, they start with net income, which is the profit from the accrual basis of accounting, and then they add back, they add and subtract stuff based on to reconcile between the accrual basis of accounting to the cash basis of accounting. So like changes in current assets, changes in current liabilities, gains, adding back gains, subtracting out losses, stuff like that. Or sorry, adding back losses, subtracting out gains that are non-cash, adding back depreciation, stuff like that. All of that stuff reconciles profitability from the accrual basis of accounting to the cash basis of accounting. So you need to look at net income, and you want to look as well at operating cash flow. Those are both important, okay? From there, free cash flow, cool, blah, 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 blah. So let's go look at the assumptions. I don't even care about the 8 pillars. I mean, it's just not, there's so many ways this can be manipulated. I don't freaking look at it. So the most important thing is getting these freaking numbers right, okay? If your assumptions suck, you're going to be screwed because you're going to put in the wrong freaking crap and you're going to get screwed over. Revenue growth. Here's why it's so skewed. Over the last year, it grew by 10%. Over the last year, 5 years, 5% per year. And the last 10 years, 3.6%. A lot of that is from acquisitions, okay? They may keep doing that in the future, but organically, the company doesn't grow very quickly. How do I know that? Go look at freaking growth under key ratios under Morningstar, and you can look at revenue growth. So this right here in 2017, 2018, that's when they had a bunch of acquisitions. So, revenue grew by 6%. But look in 2019 and 2020. Look how slow revenue grew. And then, of course, in the last quarter, it grew pretty significantly, probably because of freaking pandemic stuff. But overall, this is a very mature company. I don't think they're going to grow that fast going into the future. So for my worst case, I said, okay, they grow at 1%. Best case, 3%. You can always use different numbers. You don't have to use what I use, but I like to be ultra conservative because if I'm going to buy an individual stock, I want to be very freaking sure I'm making a good decision. Otherwise, I'll just buy the world index. Crazy, isn't it? Share change. So, if you look, they've been slowly buying back shares. I think they had a couple instances of issuances, but mostly it's been buyback. So, 2.75 billion shares in 2012. And they issued a little bit more. And then it seems like ever since 2015, they've been slowly buying back shares. So, I think the trend will continue to go down. I think they'll continue to buy back more shares. Simply because it's such a mature company. They have to reward their investors by buying back shares to increase the stock price because it's just not growing that fast. So I said, worst case, they don't really buy back anything at all because, I mean, they're really not buying back that many. And then best case, they buy back 1%. Profit margin. Here it says 19, 16, and 17. I went to Morningstar, I went to profitability, and I looked at net margin. And I like to look at the last couple of years. I mean, if you look back in 2014, 21%. 2015, 21% as well. They may have disposed of a bunch of different parts of their business, or maybe profits have just been squeezed based on competition. I like to look at the last couple of years. So looking at profitability, 2018, 2019, 2020, 2020, and the last 12 months. It's been between 17 and 19. So what I did is I said, worst case 17.5, best case 19.5 profit margin. Free cash flow is percentage of revenues. Go back to Morningstar, go to cash flow, go down to free cash flow divided by sales. Sales and revenue are interchangeable. They're just the same word. They're different words that mean the same thing. Sales, revenue, whatever. That's the beauty of accounting. They use like 20,000 freaking words for the same thing. So we look at that. Over the last couple of years, it's been between 22 and 25%. So I was generous because it was 22.71. I was generous and I said between 23 and 25% free cash flow is a percentage of revenues. PE. I was even nice here. Usually I do 8, 10, and 12. But just to help this company out for my analysis, even though that's not how you should do it, you should really use your projected future, what you think the price earnings ratio will be in 5 years. But basically, the slower the company is growing, the lower you want the numbers to be, okay? Johnson & Johnson is currently trading for 34 PE. That's freaking crazy, okay? This is a very slow growth company. It's a very mature company. Sure, they're profitable. Sure, they have a high free cash flow as a percentage of revenues, but they're a very mature company. Why would you pay a premium for past earnings if they're not going to grow that much? I mean, Alibaba's PE is like 19, okay? So I did 10, 12.5, 15 for free cash flow and PE. Because right now we're in an overvalued market. And then, of course, desired annual return. I want 15% because I'm a greedy, nasty boy. I want it. Analyze. And wow. Best case, being very generous, 3% growth, 1% buybacks. It would be a buy at 108 for a 15% return. And it's trading for 174 right now. Am I going to buy this stock? No. But you could always just change the numbers. Oh, maybe I want a 5% return. Maybe revenue is going to grow at 5, 6, 7. Let's see. Oh my God, it's a buy now. See, you can just put in a bunch of crap and figure out whatever you want. Oh, the PE is going to be 25. Let's see what that is. Oh, it's a buy. See, you can put in whatever you freaking want to get the result you want. I recommend you be extremely freaking conservative with individual stocks because you want to be as close to assured as you possibly can if you're going to risk your capital. Because if you make one freaking mistake, you can get freaking annihilated, okay? These assumptions that I just changed are unreasonable in my opinion. Anyway, that's it. Johnson & Johnson, not buying it. I don't think it's a horrible company. I'm obviously they have high margins. I mean, nothing wrong with it. I'd potentially scoop it up if the market crashed 50%, but as of right now, no. This is too mature. PE's too freaking high. The average 5-year. Okay, the PE's 25 right now. That's still kind of high. I just wouldn't do it. I don't know. Sue me. Anyway, that's it. Did you like this review? Are you going to buy Johnson & Johnson and just ignore me because you think it's a future, bro? Or are you going to buy Hippo or Lemonade like Meat Kevin told you to do? Whatever. You do whatever you want. Like, subscribe, tell your friends about me, and y'all have a wonderful day. Cheers!